Welcome to today's video. Before beginning, please read the trade disclaimer. Please understand that this is not financial advice, just my commentary and opinion. So, in this particular chart pattern, we're going to be looking at the ascending triangle. And the way that the ascending triangle works is it particularly, or in the ideal format, you want to have at least these 5 points. And the reason you want to have them, you want to have 2 touches at the bottom and ideally 2 touches at the top, with the third touch in the ideal fashion potentially breaking out. This doesn't always happen. Sometimes you can get a touch here, it comes back down to the lower part of the triangle and then can break out on the next attempt. So what we're looking at here is effectively this chart pattern starts forming with the bulls already in control. So we'll normally be in an uptrend. Bears will try to make a particular stand by holding the price as much as they can, and they will tend to do this on the high of the triangle. Okay, so what you'd ideally be looking for is looking at this as a potential breakout trade. Okay, this would be a bullish trade. It does have a high occurrence. You'll find that there are a lot of triangular patterns that do show up. It may not show up as perfect as this, but this is an example. And what you're looking at, this is the direction of this price is effectively a continuation. And it does occur quite a bit, and ideally what you want to do is look for the fourth touch, and which is part on the lower side, to potentially break out. Now otherwise, if you don't have enough number of touches, you're effectively taking a higher risk. So in this occasion, we have the price moves up, comes down, then moves up, and as price comes down, you can build the top part of the triangle. Soon as we start to get a potential bounce, what you want to do is then have the triangle made at that point. Okay, and then you have an area from that point onwards, from the touch of 0.4 to potentially look for 0.5. And what most traders will do is look for a breakout of 0.5. The other thing that some traders may do, they may long from 0.4 onwards to potentially take profits at 0.5, and if they do feel there is a chance for price to break out, they will take that. But again, that comes with experience and practice. Now, trading this particular pattern, what we must do is we need to have potential targets. So what we need to do is first we measure from 0.2 to the high of that triangle. Okay, once we have that, we then use this as a potential basis of a target for that price. And in this instance, a direct copy of this is put where the breakout of 0.5 is expected. And our ideal take profit will be the high of that top, which is a copy of the triangle, which is the high. And in this sort of case, I'll point out the different areas which one can look for looking for stops. One can look for potential entries, so that you understand how you would take this trade. So what you want to do is the points that I look for stop losses are either the last low, which is point number 4, or another stop loss point can be within the triangle, and this could be maybe a percent or so below the entry. So effectively, if the breakout fails and we come back down, to potentially retest the lower part of the triangle, we stop out a lot early. Okay, now the other place where you can potentially take a stop loss is a lot later on, and it's not ideal, but there are traders who will do that, and that will be after the breakout. Now this all comes down to the type of entry, where your position is. So we'll go through the 3 different positions. So effectively, you've got these 3 different areas, and they generate different types of risk and reward. Okay, so what you want to do in this case is decide where you wish to take your long position based on the breakout. So in this occasion, on this point here, what you're looking for is a long trade on the breakout of the triangle. This ends up resulting in a higher risk to reward in this case, because your stop loss is within the triangle, potentially 1 to 1.2% inside. Okay, and we targeted the high of the triangle. So in this case, you're looking at a risk to reward of 7.61 to 1, which is a very good risk to reward. And then on a more cautious base, you have a risk to reward of 3 to 1, and this is an entry where the stop loss is again still based within that part of the triangle, and however we enter slightly later, potentially on the confirm. And the purpose of this is, if we go from 4 to 5 and price breaks up, we don't normally expect it to reach our target. And if this now comes down to test the outside of the triangle, what you may get, if you have a stop loss in this area, you'll get stopped out. But ratio 1 is to prevent that from happening. And in some cases, you can get that wick down. But by having it like this, what you're doing is you reduce the overall risk, because your trade size will be smaller than the trade size in this area. So you're looking at 3 to 1, whereas we're looking at 7.5 to 1. And then the target is again the same. Okay, where in this case, if you do go into drawdown, it will be a lot later, but there is that opportunity. Now, if you wish to take a more really, a lower risk approach, you will get less risk to reward because your stop ends up being a lot wider. So in this case, our stop is at the 0.4 level, which is the last low on the triangle before the attempt of the break. And our entry is a lot earlier, is actually where we would have a potential stop loss for the other setups. And in this case, this generates a 2 to 1. Now, however, if our stop loss ends up being on the break of the triangle, our risk to reward becomes very poor. And so one of the problems with a low risk to reward ratio is that if you do end up getting quite a few losses, it will eat up into your profits. So ideally, you want to have at least 2 to 1 to 3 to 1 risk to reward. So in this case, we go for just over 2 to 1, and then our target ends up being the high of the triangle, which we've copied from here, from 0.2 to the top of that triangle. So it all really will come down to how you trade this pattern and how you manage that actual risk, because the higher, the bigger the stop loss, then your trade size must be equivalent. Because if you're using, say, a $500 trade size, and this is what you enter on this setup, understand that on this point here, you expect to lose 500. Same thing in this case. So if this was a $500 trade, you might be looking at, because of the risk to reward size is almost half, your trade risk may be potentially $250, where as we drop down more overall, that's how we lose our $500. And in this case, where our risk to reward is significantly less, then this is potentially could be like $125 trade, which is what $125 trade size. But if we drop down to this point, it ends up losing you around $500. So effectively, your trade size is 500 USD. I understand this is just as an example. Okay, so I'll move on to the next pattern. Thank you.